Good afternoon, everyone. I'm Desiree Bryant, RPA's Director of Meetings. Thank you for joining our webinar on financial support for nephrology practices during the COVID-19 crisis. Before we begin, I do have a few announcements. First, I would like to thank Tower Physician Solutions by Nanny for their support of this webinar. Thank you very much. During the webinar, all lines will be in listen-only mode. There will be a Q&A session at the end of today's webinar. You may submit your questions at any time using the Q&A feature at the top of your screen. You should see a little question mark icon up there. Please do not submit questions in the chat, as those are hard to capture and might not get answered. So please use the Q&A feature up at the top. There are also a series of feedback emojis you may use at any time to let us know what you're thinking. The webinar is being recorded and will be made available along with the slides on RPA's COVID-19 Hub on the RPA website. If you haven't had a chance to visit the Hub, I encourage you to do so. There's a lot of great information in there. Finally, please complete the evaluation at the end of the webinar. We hope to do many more of these, and it would be great to get your feedback. Now I will turn the mic over to Mr. James Riley with McGuire Woods, who will moderate today's webinar. Mr. Riley?
Thank you, Des. I appreciate it. Good morning or good afternoon to all those in attendance today, depending upon where you are in the country. As Des said, my name is Jim Riley, and on behalf of the RPA and McGuire Woods, I'd like to welcome you to this webinar presentation on some of the more significant financial programs rolled out over the last few weeks by Congress and CMS that are available to nephrology practices. As I said, as Jim Riley, I'm a partner in the healthcare department of McGuire Woods. I'm also the counselor to the RPA and moderator for the discussion today. McGuire Woods is an international law firm with over 1,000 lawyers across the globe and 21 offices in the US and overseas. Our healthcare and finance capabilities are among the largest in the US. With me today are my colleagues, Stacy Roach and Tim Fry, who have both been focusing a great deal of their time over the last 2 months, as you can imagine, on COVID-19 and assisting our clients with questions and issues on a variety of topics. Stacy is a senior counsel in the finance department of our firm. Stacy's particular experience with respect to the payroll protection program, and we'll be speaking on that topic to you today. Tim is a senior associate in our healthcare department whose practice involves both transactional and healthcare regulatory work for our practice. Tim will be speaking on the CMS Advanced Payment Program, the CARES Act Provider Relief Fund, as well as other topics. We have a great deal of information to convey to you, as you can imagine today. But after Stacy and Tim's presentation, we'll be taking questions as time permits. So please leave those questions in the question area that Desiree mentioned. We'll do our best to answer some of those questions at the end of the presentation. And in the event that we are unable to get to some or all of them, we'll work with the RPA and Desiree to put some of the answers up at the RPA COVID's website that she mentioned. So without any further discussion, I'm going to turn this over to Stacy, and she'll walk you through the Paycheck Protection Program and what we've learned on that over the last couple of weeks. Stacy?
I'm here. Hi, this is Stacy Roche, coming to you from nearby Charlotte, North Carolina. So I'll just dive right into this. The Coronavirus Aid, Relief, and Economic Security, the CARES Act, I'm not going to read these to you, but the CARES Act was signed into law at the end of March, and it included, among a large raft of things, it included in Title I, $349 billion for the Paycheck Protection Program, which was essentially shoehorning this aid program through the existing Section 7A of the Small Business Administration's Small Business Act, a form of loan that generally was available to genuinely small businesses for other circumstances, but they created a new section in this new Paycheck Protection Program as part of the relief under the CARES Act. This is effectively a business interruption loan, and it's administered by the SBA, but it's funded by lenders, and so the lender makes the loan directly to the borrower. So the borrower applies to the lender makes the loan is guaranteed by the SBA, and then we'll go through some of the terms of the loan as we go through. Next slide, please. So the key terms, generally speaking, employers that were in operation before February 15th, and our slide says with fewer than 500, but it's really 500 or fewer, so you can have 500 exactly, employees essentially meet the minimum standard, and there's some key distinctions. The general rule prior to the Paycheck Protection Program, or PPP, was that you had to be a so-called small business concern, which comes with its own set of restrictions. This was expanding that, so if you already qualified as a small business concern, you would continue to qualify, but this new test expands the eligibility process so that any business concern, and they also included 501c3s, 501c19s, which are veterans organizations, and some other organizations and individuals as well, can apply. For the various entities, organizations, this test is, do you have 500 or fewer employees? And if you do, then you can qualify for this plan, which sounds great and sounds simple, but we'll get into why that's actually a little more complicated than it sounds. They're counting full-time, part-time, and so-called other status employees, and they are not counting independent contractors. They've come out with various guidance that they're also potentially counting partners in a partnership structure. The applications started rolling in as of April 3rd. There have been hundreds of thousands, if not millions, of applications since then. As you may well have heard, the original $349 billion of this program has already been spoken for. So what that means is that lenders have submitted and received approvals from the SBA on $349 billion in loans, but that does not mean that all those loans have gone out. So if you're someone on the line who has a pending application and haven't gotten a word back one way or the other, that's not necessarily an indication whether you've gotten one of these loans or not before the cash ran out. It's just an indication that it has been spoken for, and your lender should let you know here shortly. In any event, the size of the loan is equal to 2.5 times or 250% that employer's average monthly 2019 payroll. And there are certain exclusions from that. Payroll costs pick up a number of things. They pick up not just compensation in the form of salary, wages, tips, and other similar commissions and compensation. There's been new guidance that it also picks up for a partner in a structure that the fixed or guaranteed income that looks like a salary is also picked up. But in each case, there's a $100,000 per year cap. So if you're reviewing folks who make more than $100,000 a year for purposes of sizing this loan, you're really only giving credit up to $100,000, and the rest of that income is excluded. The maximum loan amount is $10 million, or and that could include rolling in. They're actually including in that $10 million rolling in if you have an existing 7B2 EIDL loan you took out already during 2020 after January 15th. Those are loans that are emergency loans through a different program, 7B2, and to the extent you're using you've obtained one of those loans and are using it for the same payroll and other purposes, then you are allowed to refinance that, which is a loan with not as good terms as the Paycheck Protection Program, into your Paycheck Protection Program loan. I wanted to stop there and just note before we move to the next slide that I think this is still relevant. We expect that there will be more funds allocated to this program, hopefully as early as Monday, but certainly next week. Their most recent information as of this morning is that Chuck Schumer has indicated that there will be negotiations through the weekend on the Senate side to move it forward. Next slide, please. So the general terms, the term of the loan is listed as 2 years, and we'll get to why that's important. The payments are deferred for the first 6 months, and the interest rate is only 1% per annum. So to the extent you take out one of these loans, regardless of what happens, you don't have to make any payments of principal or interest for the first 6 months. But it's a deferral, not a waiver. I wanted to be clear about that. There's no collateral required, no personal guarantees are required. Certain government fees are waived. And so, but the real beauty of the program, to the extent it all comes together, is not only is this a low interest loan, but it can be converted into a grant based on what you use the proceeds for. And there's a forgiveness process after the 8 weeks of the loan in which they determine what, if any, of the loan can be forgiven, and it can be forgiven up to 100% of the loan principal amount and the interest on the loan principal amount that's being forgiven. So when you applied for one of these loans or do apply for one of these loans, you have to make a good faith certification that the loan is necessary to continue as an operating concern. This can include forward-looking concerns based on reduced availability of employees, of patients, of sort of basically a downturn in the business for any reason, even on a forward-looking basis based on the coronavirus impact on the economy. Next slide, please. There are permitted uses of the loan. This was on the prior slide, but I'll just run you through those. Allowable uses of the loan are this payroll cost. Payroll support is what we have on the slide, which is your payment. It's not just salaries and wages. It's also sick and medical leave, insurance premiums, retirement benefits. You can also use it for, those items are all payroll cost. And they have specified, this is not in the statute, but it's been specified in the rules, that 75% of the loan must be used for payroll cost. Now, originally they seem to have specified that just for forgiveness purpose, 75% would be forgiven only if it's used for payroll costs, but the most recent statements seem to indicate that you actually have to use at least 75% for payroll costs. You can also use the remaining 25% for mortgage interest, written utility payments. And there is a permitted use for interest on other existing debt. So in addition to interest on a mortgage, you can pay interest on other existing debt, but that is not forgivable and would still kind of be using up part of your 25% basket. So you'd be reducing the amount that could be forgiven if you chose to use that permitted use. Now, the forgiveness terms, we're still waiting for guidance on these. Just so you know, most of the guidance that has been scrambled to come out during the process has been with respect to the front-end application process. But as a general matter, the way the forgiveness works is the covered period is the term of art from the statute. The covered period of the loan is 8 weeks from the date the loan is funded. So you have 8 weeks to spend the money, and then after that 8 weeks is up, you have to go back and document the purposes for which you used it. And you have to show that at least 75% of it was for payroll costs, and then 25% or less was for permitted utility costs, interest on mortgage, and rental expense. Once you establish what the baseline forgiveness amount, so for purposes of discussion, let's say you actually did use 75% for payroll and you use 25% for the other permitted expenses. So you have what we'll call a baseline 100% forgiveness. You nonetheless have to go back and then go through two potential reductions in the forgiveness amount. One is an employee headcount reduction. And for employee headcount reduction, you're looking at full-time equivalent employees who make $100,000 or less. So you just disregard entirely the folks who make more than $100,000 for this count. And you just look at your full-time equivalents, compare them to a prior period, and determine whether your full-time equivalent headcount remains the same or not. And then for salary reduction, you look at your payroll costs. So let's say, for instance, that your headcount, just as an example before we go to salary reduction, headcount, let's say you employed 100 people during the comparison period, and you're only able to employ 80 people during the 8-week loan covered period. Then you have a fraction, the numerator of which is 80, the denominator of which is 100. So you end up with 80%, and you reduce your forgiven amount by 80%. So if you had $1 million loan with a baseline forgiveness of $1 million, it would then reduce to $800,000. In addition, they take a look at payroll costs, and this is for all employees, all positions, and they do another comparison to, in most cases, it's going to be the first quarter of this year. And to the extent that an employee is paid less than 75% in the 8-week covered loan period than they were making in the first quarter of this year, you get a dollar-for-dollar reduction in the size of the loan for the amount that you're over that 25% cushion that you've reduced their income. And so that can be a fairly complicated calculation depending on how many employees you have. But you do have a 25% cushion, and after that, you have a dollar-for-dollar reduction of any excess over that you've reduced income of the position. One of the things we wanted to note as well is that the forgiveness for federal income tax purposes, typically a loan being forgiven will be treated as income of the borrower. In this case, that's excluded from gross income for federal income tax purposes. That does not mean it automatically is done the same way in each state, so you would need to confer with your tax advisor on whether your state has adopted that as well or adopts it just by a flow-through of using the federal numbers. What happens then is once you determine the forgiven amount, so in our example, let's say we reduce the forgiven amount from $1 million to $750,000. So there's $250,000 that's not forgiven. That remaining $250,000 continues with the same low interest rate, 1%, for the remainder of the 2-year term. So the term would have started the day you took the funding, and by the time you get all the forgiveness sorted out, it will probably be approximately 6 months later, and you'll start owing most likely monthly principal and interest payments on that debt for the remainder of the period. However, you can prepay it without penalty. Next slide. We've noted before the EIDL loans can be refinanced into the PPP. To the extent you're using that EIDL for something different, you do not have to do that. But if you're using it for payroll and rent, utilities, and interest on mortgage, which are forgivable, you can roll it into the PPP and thereby get the benefit of the potential forgiveness. In addition, there is an employee retention credit under the CARES Act that's separate from this, but to the extent that you get the benefit of a PPP loan, that you don't have the right to the employee retention credit. Okay. And before we go to the next slide, one thing I wanted to mention as well, back on the prior concepts of forgiveness, there is a safe harbor that is extremely ill-defined that we are waiting on guidance on now, and that says if you would otherwise have reduced your forgiveness due to headcount or salary, but you restore your headcount and salary by June 30th of 2020, if you restore it to where it was as of February 15th of 2020, you don't have to be subject to some or all of the reduction in forgiveness. However, it's not clear if that's a monthly average, if that's just a snapshot in time. There's quite a bit of information we lack that Treasury is going to have to backfill because the statute simply didn't provide the information. And so we're waiting for the Treasury Department and SBA to issue guidance on that. So there is a safe harbor. I'd love to tell you more, but unfortunately, until we have that guidance, we just know it's there, but we don't know the extent to which it's truly offerable and the extent to which it's going to help a lot of people, or really you would have been having to do this on a look-back average basis, so it's unlikely to benefit a lot of people. All right, next slide. Circling back to a key component of the 500 employee headcount, and this has caused a lot of consternation, and it's causing a lot of businesses not to be eligible for the program, is this concept of the affiliation rules. The Small Business Administration has a very strict concept of affiliation that's much more broad than most government agencies employ. And that's because the small business agency's mandate has always just really been to serve very small businesses. And so unless your company has a waiver from the affiliation rules, and I think for most on this call it's unlikely that you do, but I'll call them out quickly. There's a waiver for certain franchisees if their franchise is listed on the SBA franchise list. There's a waiver for NAICS code 72 organizations, which are hotels, casino hotels, and restaurants, and other food services. And there's this may come into play for some of you. There is a waiver of affiliation to the extent that the borrower has financial support from an SBIC. So if you are one of those, one of those entities, then you are not subject to these affiliation rules I'm about to describe. But if you are not, and that's the vast majority of the potential borrowers, then to determine the head count at the outset to figure out if you're eligible, you have to not just count the company that you're applying through and how many employees it has, but it has to count all of its affiliates. And affiliates are based on a number of items. Majority ownership is the easiest one to understand and is going to be most familiar to everybody. Basically, if you're owned by or own more than 50% of a concern, those have to be affiliated and counted together. They don't necessarily have to apply together, but they have to be affiliated and counted together for head count purposes to determine eligibility for the loan. But there's also the power to control. Even if you don't have majority control, there can be a management control, the power to control an affiliate or individual contractually or otherwise through at least majority voting rights, or through, and at the bottom of the slide you'll see minority investor negative control. So this is where you have a minority investor, less than 50% or less, who nonetheless has control because they essentially have veto rights over the operations of the company. They can prevent a quorum, they can prevent them from borrowing debt, from selling their assets, etc. To the extent that a minority shareholder or minority investor nonetheless has the ability to veto or require 100% vote to get their approval of these actions, then they're also deemed to be affiliated. And then there's deemed management control as well. So if you have shared chief executive, boards of directors, partners, etc., the affiliation rules can say, well, you all have to be affiliated. And we can go to the next slide. There's a lot more detail on even beyond that. I don't want to make everybody's eyes cross with detail here, but there's a lot of detail about if there are options outstanding, they have to be deemed exercised. But if there's a letter of intent that's speculative, so there's a pending acquisition or merger, that may be ignored unless so long as it's not a guaranteed outcome or relatively guaranteed, to the extent it's truly contingent and really we're just talking about doing something. And you can have a termination of control, particularly in the minority negative control context, but it cannot be just a mere appearance. It has to be an actual permanent termination of that control in order to break the affiliation. So going to the next slide, we provide even more information about potential shared management, board control, and a single individual through a management agreement is managing companies. So again, the affiliation review can be extremely detailed, and you would be if you have a more complex structure, you would be well advised to seek advice on whether or not you and your borrower entity and other entities should be affiliated, and then what the head count is. For a lot of companies that, for instance, have private equity fund investments, this makes it virtually impossible for them to qualify, because the way these rules are applied, not only does the affiliation go up to the fund in the vintage of fund that they're in, so if you're in Fund 3, it has an investment in your entity, but also to the other funds, the parallel funds. So by the time you put all those together, typically it's going to be virtually impossible for anything in a PE fund to qualify unless they're one of those three cases that we talked about. They're excluded from affiliation altogether. This is all important because it's the borrower's obligation. It's the borrower's obligation to certify that they're eligible for the loan, and the certifications here are under penalty of law. They're not just simple certifications. Go to the next slide. A couple of other things. There's this notion of affiliation based on identity of interest, and they've pared this back somewhat for this program. They're really looking at close relatives. So to the extent it's a family-owned business and the family members also own other businesses that they manage, you can have a finding of affiliation there as well. Typically, the SBA determines what should be aggregated and provides a reasonable rebuttal right. Here, they're putting the onus on the borrower to certify that they're eligible and sort of giving themselves an ex post facto right to come back after the fact and challenge that if it comes up. So you need to be quite clear what you're certifying and that you've done your affiliation review before you certify, yes, my organization has 500 or fewer employees. That about wraps it up for, and there are other details, but that's a high-level review of the Paycheck Protection Program. We also wanted to give you a little bit about a new program that was announced that may be of some use to some of you on the phone, the Main Street Lending Program. The Main Street Lending Program is actually announced by the Federal Reserve. There is, in the CARES Act, a Main Street Lending Program as well that's related, but it appears that the new Federal Reserve announced version is not flowing through the CARES Act, which has additional restrictions. It is a separate program allowing Treasury to share some of the funds, but do it through a less restrictive program potentially. The Main Street Lending Program really is two lending opportunities under one roof. One is sort of a new loan program. The other is adding a new tranche of loans into a borrower's existing senior debt. These are for companies between 500 and 10,000 employees, although I will tell you some of the subsequent guidance from the Fed has been it's just if you have 10,000 or fewer employees, or you have $2.5 billion or less in revenues in 2019. These are actual loans. They are not forgivable. They're going to have closer to market terms. They'll have, for the new loans, there will be a 4-year maturity with a minimum of $1 million, a maximum of $25 million, or your total leverage, whatever amount you can borrow, such that your total leverage would be less than 4 times your EBITDA. That leverage test is going to be tight for a lot of borrowers, we know. And so we're waiting for further guidance from the Fed on the program, whether they're going to use adjusted EBITDA or just the four-corner accounting concept of EBITDA. The other program, which isn't listed here, but to the extent you already have a senior loan, it's the Main Street Lending Program, existing loan program. That one has somewhat similar terms. 4-year maturity, at least $1 million in debt. The maximum amount of the loan is significantly higher. It's up to over $125 million or 6 times leverage. But it also, to the extent that the senior debt that it's being built into is secured, then that has to be secured. This new loan program is unsecured, so that's a pretty substantial difference. To the extent you borrow this, under the CARES Act, the funds are required to be used to maintain at least 90% of the workforce at least through September 30th. It's not clear the Fed program will require that, but we're listing that here for your benefit until we know more. The interest on the loans, in either case, they started off with SOFR, which is it's the replacement for LIBOR, but there has been a lot of pushback on that because a lot of lenders have not implemented SOFR yet. So I think it will be a floating index. It might revert to LIBOR or whatever. If you do an existing loan, it would be whatever your index is plus this 2.5 to 4% margin. And you'd have a deferral of principal and interest for 6 months. There's up to $600 billion available under this program, but as of today, yesterday at the end of the day was the close of the comment period for the Fed, and I understand they got a pretty huge amount of comments. So we may get some response today, but it may be next week before we even know the full parameters of the program, and after that, before lenders start opening their window to process these sorts of loan applications. But you should be aware that they're out there. Keep your ear to the ground as information is released. There will be other restrictions. You can go to the next slide on the ability to pay dividends, repurchase stock during the life of the loan. There are some other things related to unions, collective bargaining, et cetera, that may or may not apply. We just simply, it's not clear yet. If it's considered flowing through the CARES Act, they would apply. If it's not, then they would not. Either way, though, this is not a forgivable loan. This is just a 4-year loan product with a fairly market rate meant to provide loans to get companies with a 6-month deferral and payment, meant to get larger companies than the PPP program through, or ones that didn't qualify for PPP because of the affiliation rules. With that, I'm going to turn it over to Tim.
Thank you, Stacy. And this is Tim Fry in the Healthcare Group, and it's a pleasure to be with you all. I'm going to start on the Medicare Advanced Payment Program, which is an advance or loan that CMS has provided providers, provided the opportunity for providers to take advantage of. I'm going to spend 4 slides, quickly go over the overview of the program, touch on eligibility, touch on how the MACs are driving the program, and then talk about recoupment. And then I will shift gears before we get to questions on the money that you received last Friday, many of you, from HHS. So the advanced payment is really a new iteration of something that had historically been in the regulations that would have allowed healthcare providers during an emergency to go to CMS and go to the MACs and say, we have patients that have been treated but maybe haven't been discharged, or because of the emergency, we haven't been able to submit bills. Please, can you pay us in advance so that we can keep our doors open? Effectively, CMS has said that they've used this program about 100 times the last few years. They are up to over 30,000 requests, including 21,000 have been fulfilled, and this is as of April 9th. They didn't update their numbers this week that I saw since we generated the slides, so probably even more. So it's really a program that they have stretched and shifted to kind of take advantage of maximum flexibility of the regulations in light of the COVID-19 emergency. They tried to move quickly to get money out the door. They also tried to incorporate a few of the CARES Act changes that were really about hospitals, but CMS has recognized that they didn't want to just do this for hospitals, that physicians, dialysis clinics, and many other providers are struggling during this period as well. And so they made the changes not just to the Part A program, but also to Part B as well. And effectively, it's again an advance. You can request up to 3 months of your historic fees here as part of the program that they would then pay you in advance. Different MACs have suggested different things. The consensus seems to be to use October 1st, 2019 through the end of December 2019 for what your number is. If you do that as what you request, I think all the MACs have accepted it. Others have said, though, you can, kind of average over the prior year or give you other good faith calculations. So it's going to be a little MAC specific, but there's an opportunity to use historic numbers to ask for money today. Shifting gears to the next slide on eligibility. As Part B providers, you are all eligible. You are eligible even if you receive the HHS money that I'm going to talk about in a minute on Friday. You got money last Friday that you didn't know where it was coming from, but it had in the payee line HHS stimulus or HHS payment. You can take that money, and we'll talk about what you can use that for in a moment, and you can ask for this advance payment if it's helpful. There are a few reasons you would not be eligible, and we've put them on the slide. Largely, they have to do with this is a loan, this is an advance. Medicare expects to get the money back in the future. So if you're under program integrity investigation, if you're bankrupt, if you're delinquent with Medicare overpayments, all those things, you would not be allowed to participate in the program. But for almost everybody else, you will. And based on the guidance we've seen so far, this is going to be very broad. Payment's going to be based, or is going to go to the tax identification number. Payment is based on NPIs, but so far in almost all of our discussions with MACs, they've allowed groups to submit with the group's NPI and not listing each doctor, but you may need to talk to the MAC. And there's no deadline to apply for this program. It will only exist, however, during this public health emergency with COVID-19, at least for now. So if you kind of are sitting here today and say, we don't need this program, things have gone okay, you can keep this in mind and see where you are in 2 weeks. There's not a pot of money that's going to run out. On the prior 2 slides, I mentioned this is really a program that the MACs are creating and driving on behalf of CMS. They have different forms in each of the jurisdictions that you'll have to submit. Some of the MACs, NGS as an example, they want a cover letter with your one-page application form, and for you to explain to them why you think you need this money advanced and what you were going to use it for. I haven't heard of anybody being declined based on that cover letter, but they've asked for that. So you'll want to find out from your MAC what they're asking for. Some MACs are asking for financial support of your request. Here's what we would take in a given month. Here's why we're behind. Please advance us this money. They've tried to keep it simple. The form's one page, but the forms vary in different MAC jurisdictions, and they're asking for different things. So we've tried to put this together for you. The phone numbers are not the general numbers. These are the COVID-19 hotlines that each of the MACs have created. And so you can kind of find your state. I only put 50 states. I see a question coming through about one of the territories. The territories are also eligible, but I didn't busy this up with Guam and Puerto Rico and Virgin Islands. But if you contact your MACs, they should be eligible for this program as well. If you reach out, have your NPI number, have your Medicare number handy, because you will be asked for it. The person answering the questions is not the ultimate decision maker. So take their name down, ask them if they have a reference number. Not all of the MACs are doing reference numbers in their COVID-19 hotlines, but go ahead and ask so that if you get an answer and you follow it and someone asks you later, you can say, well, I talked to Sally, reference number 1276 on April 17th. Here's what she said. Can you work with me to correct my application, correct the situation that she answered? While they're not decision makers, they tend not to make up answers. They tend to stick to their script. So I think you can trust what they're saying, but just a few tips. And it is their COVID-19 hotline, and they've been pretty good about responding. It's a loan. It has to be repaid. So if you don't need the money, don't feel like you have to ask for it. You know, it'll go as indebtedness on your books. If you have other loan covenants, it needs to comport with those. The way Medicare plans for this to work is if you asked for it today, they're hoping to respond within 4 to 6 days. So let's say next Friday, they would pay you the advance. They pay you what you asked for. It's supposed to cover an average of 90 days of traditional Medicare payments, not Medicare Advantage, traditional payments. Then 120 days will happen with nothing. No differences in how it usually works. You'd submit your Medicare claims to the MAC. The MAC would pay you for your services to Medicare patients. On day 121, that's when recoupment will begin. And at that point, the MACs will offset each of your claims 100% until you've repaid the advance in full. You will then have 90 days for that recoupment to take that down to a balance of 0. At day 210, interest will start for the first time. It's interest-free until then. They will charge interest at what they charge providers for overpayment refunds, which is right now 10.25%. That will only be on what's left to be repaid. It will not be on the entire advance. And then different MACs are considering what to do. A lot of our clients have asked, if I get to that point, can I just write a check to avoid having to pay interest? And MACs are still considering it. We think that's probably likely, but the program is still evolving with additional guidance. So that's the CMS Accelerated and Advanced Payment Program. It's a bridge loan, an interest-free bridge loan. Let me shift here to the $30 billion provider grant program that HHS kicked off last Friday. As of yesterday, 26 of the $30 billion had already gotten to providers. The balance is mainly those of you that do not have direct deposit set up. Checks are supposed to be going out in the very near future to those providers. Essentially what HHS did is they took $30 billion of a $100 billion appropriations from Congress in the CARES Act and said, how do we get this to Medicare providers as quickly as we can? And what they effectively did is said $30 billion is around 6% of traditional Medicare payments we made last year. We are going to pay everyone about 6% of what they received on traditional Medicare payments last year. And that's what hit bank accounts as early as last Friday. This is a grant. It is not a loan. It was not well planned. It was done very quickly. And so many of you woke up on Friday with the money in your bank accounts and then started to read terms and conditions that they were releasing for the first time and changing for the first time. We'll talk about that in a minute. There was a lot of fun political scuttlebutt behind the scenes that I'd be happy to share with you. Because of time, it'll probably be after this call, after this webinar. If you're interested, please reach out to me on LinkedIn if you want to hear. I'd welcome sharing some of what we've learned. But that's kind of what happened to quickly get money out the door. And now you're in a position where you have 30 days to consider, can I attest to the terms and conditions? Can I meet the certifications they're requiring? And to this end, we have been pleasantly surprised with the positions HHS is taking. CMS administrator said last Tuesday or Wednesday, this would be a no strings program. With the government, there's never no strings. And quite frankly, this is not a CMS program, so she has absolutely zero authority with this. This is an HHS program run through the Assistant Secretary of Emergency. And so they have put strings. It's about 10 pages of terms and conditions. Many of them should be easy and make sense. You can't use this for lobbying purposes. You can't use it for certain political controversies like gun control or abortion or things that you think Congress would see as difficult. It's also required under the statute to be for COVID-19 patients or potential patients. And what HHS has said this week, that's still in the terms and conditions, and it's not updated because it was after we finalized these slides, but they view anyone that has been treated in this country since January 31st as an actual or potential COVID-19 case. You don't have to certify that they were or that you thought they might have COVID-19. The fact that so many people are asymptomatic right now allows HHS to say, we think everyone is a potential COVID-19 case. It's very broad. But what that means is that their requirement that you, if you're taking this money, that you do not balance bill COVID-19 out-of-network patients may mean, and there's been some back and forth with HHS this week on this second order effect, that in this country, despite what your state may say, despite what the contracts say with commercial payers, that during the COVID-19 emergency, with this money, if you keep it, you will not be allowed to balance bill. We don't know, that's still open. There are other things that are still open, like uses of these funds. You're going to have to report to HHS. And so I would strongly encourage you not to use this money for distributions. That won't look good if it hits your local newspaper, but using it for hazard pay for your nurses or new telehealth equipment or covering payroll if you've lost a lot of revenue, that is fair game. With one exception, there's a limit on spending this on high-income individuals that make more than $197,000 annually. This money cannot be used for anyone's pay above that number. What does that mean when you've only paid someone maybe for 3 months, maybe they're production-based, and then they don't have any income coming into the practice? Can we use that for our draw for the next 3 months? Again, the program was rolled out very quickly. We have some of our best guidance for clients. We think it can, but it remains to be seen if HHS will agree, and we sort of expect more guidance here. But plan to be keeping records of how you're using every dollar, because if you made up if you received more than $150,000 from the CARES Act, which could include this, could include telehealth grants, maybe it includes the Paycheck Protection Program, you will have to make quarterly reports to HHS. So there's a lot of people that will be reporting on this program. One last thing I'll say, and then I'll just quickly show the last slide, I recognize we want to save a few minutes for questions. The attestation portal went live yesterday. You are welcome to go live and attest to your collection of this documents that you'll use these terms and conditions. But you don't have to. HHS has said that at the end of 30 days, they will deem you to have attested. And so, quite honestly, unless there is some unusual circumstance or something specific, we're guiding clients at this point not to attest, to wait, to see if further guidance comes out so they don't find themselves attesting to a statement that then the rules change. As I switch to the federal program support, just to be clear on the two prior programs I've mentioned, those are additive. You can participate in the Paycheck Protection Program. You can also participate in the advance payments and the HHS grants that were given on Friday. You just can't use the money for the same purposes. So you maybe can use the forgivable part of the Paycheck Protection Program that Stacy talked about for payroll. Maybe you use the grants for parts of payroll that wasn't covered by the Paycheck Protection Program for those above $100,000. Maybe you then turn around and use the advance payment for supplies or covering certain telehealth expenses. You can use all of them as a puzzle to try to make you as whole as possible. On this final slide are a couple other pieces of the puzzle that maybe can try to support you at this point. Medicare sequestration cuts, the 2%. From May to December will be held up, and so therefore you'll be seeing a little bit of a Medicare add-on payment, so to speak. If you have significant Medicare Advantage penetration in your market, but you're not in network, there are rules that Medicare Advantage plans have to include you during this emergency period. There are a number of business tax provisions that our folks would be willing to talk about with you further that'll also be helpful to your business. And finally, I think Stacy mentioned a couple times, we expect more from the congressional response. So please stay live and continue to monitor those things. So I'll flip to our contact information because we will not get to all the questions I'm seeing come through in the next 8 minutes, but I'll turn it back to Jim Riley. And again, thank you all for everything you're doing. We really appreciate it.
Very well. Thank you, Tim, and thank you, Stacy, as well. It looks like we have about a little under 10 minutes to be able to answer a couple of the questions. Let me turn it over to Stacy first to try to address a couple of the questions that have come through as we've been going through the presentation. Stacy, are there a couple of questions there that you think you can answer?
Yeah, well, I think I can answer a lot of them, but we don't have time for that, so I'll answer a few of them. First of all, I've seen several questions come through asking about the $100,000 limit, so I thought I would try to address that. The $100,000 limit, when you're calculating your payroll cost up front to determine the loan size, is limited. We've gotten new guidance this week that indicates that $100,000 limit applies to the salary, wages, commissions portion, and to the extent that a payment of benefits in the form of leave, so sick leave, family leave, those sorts of payments, excluding, just so you know, to the extent that it's CARES Act family leave paid for by the government. You can't count that. But to the extent that it's paid family leave, paid sick leave, wages, that has to be all in no more than $100,000 per year. So for your monthly average, you'd have the rateable amount of $100,000 per year. But they have excluded from that, so you do not have to ratably reduce the amount of contributions to 401ks, payment of state employment taxes, and payment of health insurance benefits. So those items you can use the full amount of, regardless of how much the employee made. So I wanted to make that distinction. One of the questions said, look, if we use the $100,000 limit and contributed $19,500 to a 401k, does it mean we cap at $119,500? Effectively, yes. You get the full value of the $19,500, but you cap the actual income, the salary of the individual, at $100,000. And then on the back end, when you're doing forgiveness, I wanted to clarify something I said earlier because I believe I muddled it, but when you're doing the salary reduction, so when you first calculate payroll cost as phase one, how much gets forgiven, you do the same thing you did on the front end for $100,000. If they made $100,000 over $100,000 salary and leave pay, you only get credit for $100,000 of that, but you get the full credit for the other benefits as we discussed. Then when you go to the reduction based on salary reduction, anyone making over $100,000, you just exclude entirely from that. So they're not going to count it against you to the extent you're cutting the salaries of people who make more than $100,000. That's just excluded. They're really looking at how much you're reducing the wages and salaries of the people who are making less than that. That's what that salary reduction is. For the head count, the FTE head count, you are including people who make more than $100,000. You're including them then if they're an FTE employee. What is an FTE employee? I think several of you have asked, and unfortunately there's no guidance precisely what that is. We've been advising people to use the tax concept of 30 hours or more, but we're hopeful we'll get better guidance on that from Treasury and the SBA in the coming days or week so that people can start preparing how to prepare for that. On a related note, what documentation is required for forgiveness? That, again, we're looking for more guidance, but you're going to need to provide the tax form that can show the amount of payroll paid. If you have a payroll provider who calculates that, you need to be able to provide that. They're basically looking for third-party items that prove out the amounts that you paid, and that amount paid for forgiveness has to be paid during the 8-week period. Again, this is subject to change if guidance is issued, but based on the current guidance we have, the statute and limited guidance on forgiveness, only money spent in that 8-week period is subject to forgiveness, so you can't spend it after the 8 weeks and still get credit for it in calculating your forgiveness unless something changes. And with that, I'll turn it over to Tim, see if there's any he wants to answer.
Yeah, just a couple that I quickly was trying to point out as I flipped through, and I'm sure we've missed some. So we, again, welcome you to connect with us, whether that's through LinkedIn, email, or whatnot. But one of the questions was asked about kind of the balance billing time period for that. My expectation would be that's going to be for the pendency of the declared public health emergency. And the Secretary of HHS declared that back in January at some point in the potentially not very distant future, according to the White House, that may be declared over, but I think there'll be a date that'll be set and kind of announced, and certainly part of that. Another question that came in was asking about the HHS stimulus and how it could be used. For instance, what happens if we've had to shut down one of our locations or shift patients a room and we need to kind of build out the space. That's a perfect use of the funds. It's right in what Congress was included in the CARES Act before HHS tried to stretch it even more. They were definitely having in mind hospitals and other providers setting up tents, taking out space in strip malls or whatnot, wherever you can in the community to provide spaces. So you absolutely can look at that. Let's see a couple others. There was questions about reporting for the CARES Act provider relief money. Are there details? Not yet. We know that if you've received over $150,000 from the CARES Act, you will have to do quarterly reporting. We do not have a form yet. We don't even know what they're going to ask for it In the terms and conditions, they do include certain regulations that are specified where you have to do certain record keeping, you have to have certain written policies in place for how you use HHS grant money. We're very hopeful that HHS will recognize that a lot of those regulations are not applicable, but stay tuned over the next month. I think we'll learn more, and you may want to work with your legal team to develop such policies if that's required. And one other question on this reporting is, what happens if we got less than $150,000, but we did the Paycheck Protection Program? Is that all lumped together? Today, I would assume yes, but there is going to be a lot of discussion with HHS because you're really not getting the PPP program directly from Congress or from a regulatory agency. You're getting it from a bank. So I think that, kind of remains to be discovered a little bit as well. And with that, Jim, Desiree, I know we're kind of at the top of the hour, and so I'll hand it back to you and recognize that there's still some open questions.
Yeah, let me close and then turn it over to Desiree. We certainly appreciate all of the attendees that we had on the call, on the webinar today. We hope that you've gathered a good deal of information on this ever evolving and ever changing environment that you're all having to deal with on a daily basis. I'd like to thank Stacy and Tim for some tremendous information relating to these new programs. As I said at the outset, we will take the questions that have come in and try to respond to those in a more consolidated way on the RPA website. But I did note that there were a number of questions relating to dialysis joint ventures. And because all of those are very specific, particularly with regard to the affiliation rules under the PPP, those are going to have to be, addressed more specifically. So if you haven't gotten the answers as we've been discussing, I'd suggest you reach out to one of us on the webinar here to talk about those specifically. Your particular documents are going to really dictate exactly how those play in relationship to the affiliation rules. So with that, Des, I'd like to turn it back to you.
Thank you, Jim. I appreciate it. And thank you, McGuire Woods, for an excellent presentation. I know it was a lot of information for everyone, but please check out our website at the COVID-19 Hub. You'll see, all you have to do is click on that ad on the homepage. It'll take you straight there. It's a lot of great resources. The slide deck will be there before close of business. I'll be putting that up right after this webinar. And then the Q&A summary and the replay will be up there next week. So again, we appreciate you all for joining us. Again, I'd like to thank Tower Physician Solutions for sponsoring this workshop. And you guys have a great weekend. Be safe and stay well. Have a great day, everybody.
Thanks, everyone.